Mr. Dustin Garrow. How are you, sir?
Doing well these days, although the uranium market is not encouraging at this point. But we'll cover that. So
It's not encouraging, but it is a whole bunch of fun, I think. It's a
yeah,
whole bunch of fun.
where else are you going to get this much fun? So at
Yeah,
such a low cost. So
it's
anyway,
like an American soap opera is what it feels like. Right, okay, well, literally, there's so many moving parts at the moment. I was in PDAC recently, had lots of fun and games there, lots of excitable CEOs in the uranium space and a few depressed ones as well. We got to start with what's happened to the spot price and does it matter?
well, the answer is quite a bit, unfortunately, on the downside, as you know. And I just took a look at it the other day. I mean, up until like November, we were high 70s and the 80s, and now it just fell off a cliff. Well, there's a lot of reasons, a lot of talk going on, and it's winding up of ANU. A couple million pounds was forced into the market. That's one factor, I guess. The Trump tariffs. I think the injection into the market in general of Trump and the trade wars is causing a lot of uncertainty because, as you've probably seen, he'll announce a tariff, then he'll suspend it, then they'll say, "Oh, we're negotiating some solution here." It's like the tariffs coming out of Canada. Is it going to be 10%, 25%, zero? You just don't know. So people are trying to pre-position uranium to converdine, and there's all of that. There's the war in Ukraine. Um, if that gets resolved to some degree, does that then mean Russian fuel is acceptable? And then it will re-enter the Western market. Um, I know Cameco's tried to address that on their quarterly call, and you go, probably not in the volumes that we saw before, but I think there will be utilities in the U.S. that go, yeah, 5, 10%. Well, that'll affect how people view the market. I think it'll be, I think, again, as Grant Isaac said, you need it. If you believe in the demand forecasts to any degree, then you really need all of that. That's why we're having restarts. That's why you need greenfields uranium mines. And even then, it could be a tough slog. But, so all of that. And I talked to a fuel manager just the other day, and they said, so the answer is you step back. Hopefully you're kind of covered for a while, 2, 3 years out. You got inventory, you got flexibility under old term contract, whatever, and you kind of let things hopefully settle out. But again, it's this idea that the $64 is now the new normal. We just kind of got here, but what I'm hearing more and more is that mindset of, well, now we have to develop a strategy of $65 spot and 80 term. Gee, if spot's so low, term needs to come down. The floors, I think, again, Grant mentioned this in the call, that I think some of the utilities are saying, hey, the floors under the term hybrids, they have to come down, to reflect the lower spot price. So to answer your question, yes, it matters because, the investment community looks at the spot price a lot. And I think availability of capital. I'm hearing that more and more, that if the price stays low, then raising large quantities of capital to build that massive mine in the Athabasca, let's use that as a reference, maybe not quite available on the time frame that one might like. So I think, it's all of that. If you look at the volume, though, I mean, the volume last year was below 50 million pounds. And I'm being told that, there's just not a lot of material around, but there's not a lot of demand right now. I think some of the funds aren't buying. With what's going on in the general stock market, I think some of them may want to slough off some of their positions. The other thing that's coming up that has the spot price has an effect on is carry trade. When you get a disparity of, let's use $15 between spot and term, we hadn't seen that. So the carry trade, and that's midterm. So in other words, a supplier agrees to deliver starting maybe a year, 2 years from now, out 3 or 4 years. So it kind of underlays that period. And I was told the other day, well, take $64, put a 7% carry on it, compound it, and then do 80 at 3%, because that tends to be kind of the escalation that's included, the GDP deflector. The crossover isn't until 2029 or 2030. So, but then I said, well, wait a minute, but look at the volumes that are available. And they said, yeah, the carry trades aren't offering millions of pounds. It's hundreds of thousands, but they're filling the gap. One fuel manager told me very recently that they did once-off deliveries in 29 and 30 under $80. So he said it's really hard to take that, pick a number, the $80 term contract, up to management, because they'll go, well, wait a minute, the spot 60, and then you get the carry traders that come in and say, well, I don't use 7%. I get cheaper money, maybe from a Japanese bank. And so I can offer you pounds even cheaper than that. So, we're back in that kind of market phase of carry trade deals for, and we're talking 100, 200,000 pounds is all, not big volumes, but it's enough to kind of skew the market to where I think some of the utilities, the U.S. still needs to contract for a lot of material. I mean, it's a pretty big number, but they're saying, hey, I'm covered till maybe 28, so I can see what's going on here. We're discussing, discussions are going on with producers. They're still meeting with utilities. So the impression is there's a lot of material that's kind of available out there. Well, no, it's the same guys talking to a bunch of different utilities with fairly small volumes. We've got the startup situation. We had some fairly negative news come out of Encore. Now, I think that's temporary, but I think it underscores the fact that even, a mine that was in operation in the past, been shut down 7, 8, 9 years, you don't just turn the switches on and you come back into full operation. There's a ramp up period. And I think there's been a little bit of underestimation of how long that might take. The greenfields mines. I mean, all of this, it's all kind of wrapped up together, Matt, as you know. Next gen coming out, the final permitting hearings pushed off till late this year. And so there are some analysts saying, well, then they really can't get going from a production standpoint until 2030, 2031. And they even admitted it in their press release. We're having to reevaluate kind of the startup time. So, again, we've got so many moving parts. We've got demand growing. I mean, every day there seems to be a new piece of information. It's Singapore, it's Ghana, and a lot of it's SMR, Germany with the new government. And that made it clear we're not going to restart these old reactors, of which they have 17 originally, but SMRs. So now there's a much brighter light being shined on the SMR community, and that ignores the hyperscalers. The data centers that, as you know, are looking natural gas transitioning to SMRs, most of them, restarting reactors in the U.S. because of long-term purchase power agreements, 10-year, 20-year. So, I mean, it's really affecting kind of the demand growth side of the industry. And we've not seen that in the market yet. I heard the other day some of the artificial intelligence guys, or let's call them the hyperscalers, are beginning to look at the fuel markets. In other words, if we're going to be adopting that technology, is the fuel readily available? And I came across actually earlier this morning testimony from Dow Chemical that wanted to put a 4-pack of 90 megawatt X energy reactors, micros, in their plant in Texas, chemical plant. And he made the comment, he said, if I can't be comfortable that there'll be enough fuel, I can't do that, because if I put in gas, I can always get gas somewhere. So, it's going to start to become I guess, a more focused discussion with the data center group. So, like I say, the list is so long, and then trying to I get asked, well, then what does this mean? And you go, my sympathy goes out to trade tech and UX and others that are trying to put all this together and say, well, here's what it means. To me, it means more pressure on available uranium supply. We just can't, if you believe the demand forecast, what happened at the conference in Houston this week, all the data center guys signed on to the tripling of nuclear declaration. Well, that to me is different than some of the other groups. These are the guys with, let's say, this is an understatement, a lot of capital available. They have very aggressive plans that they have to, at this point, meet on data center construction. That, billions and billions of dollars. And people kind of lose sight of the fact that the utilities, the electricity is their product. That's their output. So they view generation and fuel a little differently. To the data center guys, it's an input to their ultimate output. So they need to make sure it's available at an acceptable cost, and we can go through all that. So, I've been around, as you've pointed out sometimes, quite a while. I've never seen the market like this. First of all, from not bifurcation of spot and term, because there's still a linkage there, but they're starting to act a bit differently because of the participants. Quickly, term is primary producers and the utilities so far, and they kind of go about their business the way they do it. But the spot, UX said that sales last year, 93% of the sales were done by intermediaries. Now, what does that mean? That's trading companies, that's hedge funds, that's, they're kind of becoming different markets with different underlying business models. So then you got to try to capture that, because then they interact to some degree. So it's just unbelievable. To try to do a deep dive, good luck. It's just
we can do a deep dive. I think there's a lot of moving parts, as you say, and trying to understand each one and come up with an answer which seems reasonable is a process we can go through. Obviously, the bottom line is, in fact, if we do, look, I'm going to try and do some of that today, right? And I want to start with this message. I say, look, I'm positive uranium for the companies that can produce. This is all a fantastic outcome for the companies who can produce. The problem is there's not going to be many of those, okay? And unless they get rolled up in some kind of M&A and get access to the upside, there's not many of the current participants will be able to, benefit. So I'm pro uranium. I'm really excited about the outcome, because all of these pressures mean there's a huge amount of scarcity, and that usually means one thing. However, let's get into it, because it'll sound negative if we start going through each of these things without stating that that is our not just our preferred outcome, but I actually believe it will be a positive outcome for some companies. But for investors, we need to pick the right companies. That's where I'm going to come back.
And one interesting data point, which I just looked at the other day, was I went to the WNA reactor lists and uranium requirements. It's about 175 million pounds. Everybody kind of agrees that's reactor consumption is how they model it. And I went back 20 years and the number was like 173.
Yeah.
So, and you go, well, it's a different mix of reactors and, on and on. But the market is about looking at the same demand so far. All the SMRs, the new reactors, that's potential demand, but it's not come in the market yet. And so it's right there, I think, at the edge. But that I always thought was an interesting data point, that the market is still the same size as it was 20 years ago.
Yep.
Even with Fukushima and everything that's gone on, that's been replaced by China, and you get the different actors. But anyway, and there are some consumers. The Chinese are still very aggressive in the market, meaning looking for future supply. They really are kind of showing up everywhere. So they have done the sums.
They've done the sums, and they're doing something about it. They're walking the streets. But let's kind of get into this, Dustin, right? And I'm going to talk about, we'll come back to this kind of we'll probably start with the utilities component, and we'll go on to the political uncertainty and spot market and the impacts. And I think we'll talk about the future demand drivers, like we always do. I think M&A and supply is really where I want to kind of hang out in this conversation, and then ultimately things like processing bottlenecks, etc. is the usual things that we discussed. But I think in here will be, I hope, some new ways of looking at this, and maybe reshape the way that some investors come at this. So let's start with the utilities first off. Right. So this industry, this space has been talking for 5 years, coming up 6 years, about the demand drivers and so forth. And there you are, you've laid out for us, actually, the demand right now is no more than it was 20 years ago, guys. So something's not quite right there in the sense that the demand is maybe moving around with different players and different locations, etc. But the bottom line hasn't changed. So what's going on? In terms of the behavior of utilities? It's surely up to them. They should be filling their boots at these sorts of prices, given where everyone thinks the price of this is going to go, whether you use spot, whether you use term, but they're not. So, and if they don't at these sorts of levels, I think general perception, certainly from some things you said today, is that it isn't enough to incentivize greenfield production. So why aren't they moving? Why haven't they moved?
Well, I'm certainly of the school of thought that they look to the market for signals. Okay. And so the term price went from 68 end of 23 up to 80 at the end of the first quarter of 24, and it's just been flat since then. And there have been some contracts done, not nearly. I think the U.S. utilities did about half of the normal run rate, which is 45 to 50 million pounds a year last year. And they've pretty well covered their needs over the next 3 years, let's say. In general, some need pounds sooner. And then the uncovered component gets really large. But I think what they're saying is, okay, how do I know that demand is going to show up in the market? Now, IAEA is saying 2025, you're going to see more reactors enter operation, because it's that lag time of, like you say, 5-6 years. Takes that long to build the reactors. So I think we'll start to see more market activity, and that'll be a positive signal for the suppliers, and it'll be a signal for the utilities to then begin to move. There was a big utility conference a couple of weeks ago in the U.S. Virtually all the utilities were there. And some of the feedback I got was the level of complacency was very high, and the lack of market knowledge. They really don't dig into what does it cost? Who is out there committing? Last year we had the Chinese, supposedly of that 120 million pounds plus term volume, they bought 40% of that from the Kazakhs. I mean, that's a huge commitment. So some of the programs are looking at that. And the year before, there was a big contract with the Emirates. So, but the U.S., I think they're still dealing with conversion and enrichment that went up at astronomical rates. And uranium, they've not really focused on it as much as some of us think they should. And I think once they do, which should be fairly soon, they'll start to make decisions on their long-term needs. I mean, again, these reactors are getting operating license extensions. A lot of them are 60 years. They're moving to 80 years. And now there's talk of, well, you need grassroots exploration. There's not enough identified pounds from the old days that you can put those all to work. There's some, but not enough, that you've got to send the geologists out to, Northern Australia, South America, parts of Africa. Well, at current prices, nobody can afford to do that. And you hit on a good point. I think the M&A side, the industry needs to get, I don't know, stronger is the right word, but you need to have larger producers, 5 million, 6, 7, 8 million pounds a year, just to support their requirements and things like grassroots exploration. And, it used to be a £1 million a year guy could kind of make a go of it. Going forward, I think it's going to be larger companies. And so that's going to, have an attrition, but it should be better for the industry and the market as a whole. So
sticking with utilities, because let's say lots to talk about. Sticking with utilities, do you think that they're looking at uranium developers and the existing producers? We're saying, Cas out in front saying, actually, we're going to produce less. It's costing us more money. Cameco, they're not rushing back into production because they're not making as much as they used to your point. And the utilities are going, these guys need to get their act together before we kind of commit large sums of money to this energy source. I mean, they can look at conventional gas. They can stick with their existing fossil fuel solutions. They can look at other technologies. They can do what they want. I mean, just because we like uranium, I mean, they gotta that's what they gotta use, right? So I'm just trying to have a reality check here and go, if I'm a utility buyer and I'm trying to, what I'm trying to deliver is energy. Doesn't matter where from. Obviously want it to be as high margin as possible. Their business is trying to make money here. But if they back themselves into a corner by backing, nuclear, and we can't deliver the fuel to, feed their infrastructure, that becomes their problem all of a sudden.
Yeah, and I think part of it is, it gets back to show me the orders. There's a lot of discussion about where the nuclear is going, doubling, tripling, and all those. Those are great targets to have. But, show me that firm order for that next big reactor that needs that 2 million pound core, needs that 500 plus thousand pound a year refueling. Haven't really seen a lot of that. I mean, a lot of potential. So I think they're being cautious. They seem to be more concerned now about paying too much. The word is that perhaps some of the recent contracts that were done they were based on spot price at time of delivery, but they only had a ceiling. Now the ceiling was high, but the utilities were willing to agree to that to have no floor. So they're saying, I don't want to be caught off sides with a $90 contract and the spot price goes to 60 and I could have covered a lot cheaper. So, I mean, there's all of that they're looking at. And the other thing, Matt, it's interesting, early signs, but the procurement strategies and programs, you may have seen the Koreans. They were very strict on official RFPs and the terms. When they came out in late 23, they did not get a very good response. So they went to a more regular off-market strategy where they have suppliers they'll deal with, and they just kind of keep the dialogue going. Some of the U.S. utilities are starting to do that. So this idea of a term contracting cycle, I think, will be impacted. I've been told we plan to be in the market continuously. We will do spot, carry trade long term. We will do conversion, everything to where we think we're optimizing our fuel cost. No more, a reduced interest in that fixed price, escalated. Well, and they can only do that if the suppliers respond. I mean, there's an ingrained different perspective where Cameco says, well, we're not going to produce that until you commit to buy it at a good price. So, but I think the give will have to be the utilities. The suppliers will go, hey, I can do, like you say, the utilities can do other things. The suppliers can do other things. So
yeah, and there's a few other players in here. There's some financial players in here which kind of are driving this kind of spot market too, right? So, there's a trouble. It's so intertwined, and we're sort of watching this sort of regression at the moment because the structures that some of these financial players have created for themselves mean that they can't go out and buy. They can't sort of, dominate in the way that they have done previously. And this comes back to a conversation you and I had probably about 3 years ago when we're hearing, we're talking about Sprott here. We're talking about Yellow Cake and others here, where you're saying, we're going to buy, we will never sell, which sounded ludicrous then, and it may sound even more ludicrous now because they're at a point now financially where the structure they've created for themselves is, well, it's going to get tough. It's going to get tough. They're going to come under pressure from their shareholders because within this kind of market, unless they're very, very patient. So do you think we'll start to see a release of, pounds from those guys in the market, and what's that going to do?
John at Sprott, who oversees that operation, made the comment just the other day that they may have to sell some just to, again, fund the support of the trust. I mean, they've got storage fees for 64 million pounds have to be pretty large. And so you've got ongoing costs. He didn't suggest they were going to begin to liquidate their inventory, but, they will be under cost pressure. There's rumors keep coming up about Yellow Cake. Are they going to, sell? That is not part of the program right now, but as you say, the market continues to change. One thing I find interesting, though, is the business model for the sequesterers. It goes back to UPC, Uranium Participation Corp. Never was accumulate and increase with the increasing price. It was always, it's a fund, it's got the physical, it'll go up, the price will come down, and you as an investor can then make your decisions on, do you go long, do you go short? But the other side of the coin seems to have gotten lost in the ongoing upward pressure on the price. I mean, Yellow Cake started at $21, and we saw prices of $100 early last year. But then sometimes the spot reverses for all kinds of reasons. And it was my understanding years ago that, well, then the investors could say, okay, I'm going to short the stock, and I'm going to use that as my, anyway, be that as it may, we'll just have to wait and see how the decisions come out. And do, certain consuming groups in the Middle East or in Japan or whatever say, hey, I'll buy the fund. I'll have 22 million. I don't have to worry about mines flooding and regulation and all this. I'll have 22 million or 64 million pounds at a converter. So I don't know. Could that happen? Could.
Yeah, it could. Just just sticking with it. Sorry to be so. I do want to kind of dig into it. I think it's important. So with utilities, whether they're kind of privately negotiating off market contracts, or whether they're trying to manage the kind of flexibility as to how they kind of draw down inventories or commitments and etc. It's clear that there's got to be a new. If they do that, there's going to be a new way for uranium companies to think about how do they finance what they do, right? So we talk a lot in this industry about incentive price, and I think when it was 2019, we might have been around $45. Then it was $55. Then it was $65. I think we're people talking about $85 now. Some people talk about the reality is probably over $100. So so it sounds like the incentive price is this, so therefore the market must react to our demands, our needs, and it doesn't kind of work like that. It does not work like that. And as an ex-banker, when I hear these sorts of conversations, I get a little bit nervous. You talk about Athabasca advanced projects when they've done their economic studies, and we know how well they go, 9 times out of 10. We missed our budget, folks, awfully sorry. That makes bankers really, really nervous. So especially the larger the capex, we won't name names, but I think everyone knows we're probably talking about a couple of companies that need to kind of give certainty over and especially when it's new build with new teams who've never done it before. It's hard. There's not a lot of people who've done it before. If I, as a banker, I'm like going, well, are you sure about these prices? Even if I discount or multiply this number by whatever 0.4, am I going to be making money? Maybe could be. With my money as a banker, I'm going, there are easier, less risky projects with which to probably guarantee better my return. So that kind of incentive price conversation versus the reality of actually getting a hold of the money, even when you hit your incentive price, it suggests that we may need to see these term contracts, if they are being signed like this. Utilities are changing the rules there somewhat. Spot price will need to move and react to kind of help the kind of momentum sentiment thing. But me as a banker, or bankers like me, would just go, well, I'm still really quite far away from the number that I need to get comfort. So how do these uranium companies expect to finance a $2 billion, $3 billion, heaven forbid, $4 billion capex going forward? And then what is that lack of response and the supply to the market going to do to the market?
Gee, probably increase the price. If you go back to the old days, how were uranium mines built? Be it, Rio Tinto, be it, some of the big mining companies. It was one of 50 projects they were working on. Capital was raised up here somewhere. The bank debt strategy was not widely used. Okay. The White Mesa Mill in Utah was built with Swiss utility funding. The Rossing project had Japanese utilities involved. The Spanish were in Niger. Is there a call for the bank financing? Yeah, it has its role, but is there a call for different thinking on how you raise the capital? Is it the AI guys? Do they come in as investors and say, okay, I'll pay for half this, but I want part of the output? See, that's the problem, is they always want the output. So the mills that are left in the U.S., there's Shooting Canyon in Utah. That was a utility. Plateau Resources. Sweetwater in the Red Desert. That was another utility that funded all that. So the funding through equity, there weren't very many public uranium companies, straight uranium companies. Little guys, Uranium Resources, that raised a little bit of money. Everest, that built the Hobson project in South Texas that UEC now has, those were friends of the owner he went to school with, put the money in to build the first processing plant. So the banks weren't involved, at all, because, as you know, they have certain criteria, certain mindset. it's the old, they won't lend you money unless you don't need it. They always risk averse. And I understand all that. That's not kind of their job to fund what they think are risky projects, unless there's some goodness involved. When Paladin did Langer, the banks got warrants and got all kinds of things. And the word from Societe Generale was that was the best mining project they'd ever invested in. So you go, well, is there a call for different Westinghouse Cameco? Should they, they look at different financing vehicles? Do you let let me be, speaking for the producers, do you let the banks be a drag on this industry? Because they go, well, no, show me and prove and how come and, and you go, then you can't do anything. So it makes the situation worse. As we've talked about, do the utilities sense trouble and go, I don't like it, but I'm going to become an investor in a mine, as the Chinese have done? And in the, again, back on the U.S., there were like 28 uranium projects funded by the utilities because they were the ultimate consumer of the product. So you go, well, if you want this, bring your checkbook and become part of the issue, So again, do we face 5-10 years from now, or the banks kind of, but is it BlackRock who buys the ports in Panama and they're now looking at nuclear? Does BlackRock go, well, I'm managing 15 trillion. I can probably peel off a little bit for that guy in Wyoming that'll, I think the industry's set for big changes. The old ways don't work very well.
That's my point. That isn't the point. We seem to be stuck in this, and I've been hearing the same thing for 5 years. And I was hearing it back in 2010, 11, when we were financing these things. It's the same story and the same hope, and it's just not going to work. But and again, sticking with this, what does that mean for the current batch of near-term producers in terms of their ability to find this stuff? Because I'm sure if you put a call into USAID, they might have been able to help, but their phones haven't been answering recently. So we got to find the next batch of big money. To your point, the tech guys, they're going to want it for themselves. It's nothing to them. It's nothing. Bankers do care about making returns because they get judged on it. They also get, pick up a few bonuses off of doing good deals. This doesn't kind of qualify, and then the risk is still too high. So what is this going to do to supply? Because I've talked to a couple of near-term producers recently, some with small capex requirements, which I think they should get over the line. Others, there's much bigger numbers involved, and it's like I'm struggling to sort of see who's taking that risk for them. So if that does not happen, and it does not, therefore the supply does not react in that time frame, as in the indicated time frame, 2030 time frame, again, it's not a good look for the sector. It's not a good look for uranium at the moment.
Well, first of all, on the current financing models that have banks involved, I think the spot will improve, and I think some of those will move forward. Okay, they'll have.
Where's that come from? Where's it come from? Yeah.
The spot is so thin now. All it takes is somebody, a lot of people are talking about they want to be traders. Well, then you have to have inventory generally. So I think it would not take, and in fact, Sprott, the comment was there's not a lot of material out there. So to get from 65 up, last year there was 1 month that went up $10 in a month. So it takes, what I wrestle with is the mindset that it's going to be the way it is today forever. Oh, well, now it's changed. So now it's going to be this way forever. Oh, no, now it's going to be this way. That isn't the way it works. I'm sorry. And at $65, it isn't going to work. I agree with you. If the price stays at 65, there's no new projects. Okay, then the utilities either I don't know how they get their fuel. Will there be reactors that have to suffer because of that? Could. Keep in mind the Indians operated below 50% capacity factor for years because they couldn't buy fuel because they were the Indians. Well, not much the suppliers can do about that. What about equity? In the old, make these projects 100% equity, no gearing. They're risky. Nobody wants to get involved, but boy, the upside could be significant. Does that mean nobody does that? I don't know. I mean, is it a mix of utilities, of funds, of whatever? The AI guys all come together, and the banks play a minor or no role in the financing in the industry. There's nothing magic about the banks, in my view.
No.
In fact, if they're going to be a hindrance, then you find a different way to do it. And there's smart, in the finance area, there's smart people that will go, wait a minute, we can do it this way. And the banks will go, oh, well, I should have been involved because I would have made money. Well, too bad.
What comes back to your point earlier, I think you started off in talking about, whether it's Trump tariffs or trade wars or actual wars, but uranium's had that to it. We've had that in the mix from the get-go, from, the section 232, or get my numbers wrong, section 232. Then we've had the, actual, sanctions, etc. We've kind of had that in the mix, and I can sort of see why bankers avoided that. We certainly did. You talked to me about coups or sanctions. I'm out of town, gone. So that, again, that hasn't really helped. It comes back to the geopolitics and uncertainty, etc. But again, this is my promise, my last point on utilities. But you're the guy that knows quite a lot more than anyone I speak to on about utilities. Is when we're sort of seeing the buying behavior from utilities, in terms of this, like, say, private negotiation off market, etc. Is that their attempt at sort of keeping prices lower, or is it just or do you actually believe it's genuinely a more strategic approach, from their actuaries to say, like, there's a strategic approach to procurement, and depending on your answer there, do you think that even they, with this kind of rather conservative approach, would ever be forced into panic buying like we've seen in previous cycles?
They have in the past. I think, going back, let's just pick 20 years, the utilities would be very specific. I have needs starting 2 years out. It's this much each year. You don't get that from them anymore. They come in the market and say, I'll buy up to 500,000 pounds, and they buy from 3 suppliers and they acquire 1.5 million. So they're trying to be more secretive in what they're doing, and that's okay, But what is the ultimate outcome of that? I mean, I was shocked. Encore, they said they had 7 contracts, and then recently they said they had 12. A small producer with 12 contracts? You go, really? Paladin, they've got 11 contracts now. And is that a good strategy? I don't know. Again, the industry, years and years ago, when I worked at Rocky Mountain Energy, part of Union Pacific Corporation, we were funded by Southern California Edison and San Diego Gas and Electric. They funded our uranium exploration. They funded the building of the Bear Creek conventional project. I had the audacity to tell the corporate planning guys that uranium was risky. And boy, did they listen. Because as soon as the utilities were told by their state regulators they couldn't fund the fuel side anymore and started to withdraw, Union Pacific got out of the business so quick. Maybe the business is that different that it needs a whole different financing structure. And maybe it's not possible. Well, then the utilities have to stand up and go, well, if we're going to build, or the AI guys, we have to become involved. And maybe they bring in funds that, who knows where they come from. So, yeah, I think as I've said recently, the old ways of doing most everything need to be re-examined. It just isn't going to work in the future. It's going to be bigger companies, more sophisticated financing. The marketing is going to be more ongoing. And so you've got to have the product available somehow rather, and then maybe that's utility underwriting. I don't know. I mean, I think it's just going to be really interesting. So
yeah, well, definitely, it's always been interesting. It's just, I think there's a lot of people trying to make money, uh, well, sort of dissecting everything that's going on. I think it was, well, anyway, your recommendation with Union Pacific is Myriad's gain today. That's what I look at that one.
And it's still risky 50 years later. Anyway.
Still 50 years later, right. Tom Lamb, do your thing. I hope you get there. Right, okay. And just in terms of, we talked about actual wars here, which is obviously, potential, maybe, could be, potential peace between Ukraine and Russia. Do you think that is, it's a two-part question, do you think that, most of these are, do you think that is maybe says, well, these Russian sanctions might sort of get taken away? And also there's sort of talk about, this, unilateral discussion, these conversations to disarm nuclear in Russia, China, and elsewhere. Is that going to do what it did back in the sort of 80s, where we're going to see a slew of warheads being decommissioned and then flooding the nuclear market?
Yeah, first of all, on the Russian ban in the U.S., I am very convinced that because it was unanimously passed by the legislature, you're not going to overturn it. But what I'm hearing lately is there's a possibility of, the waiver aspect of it ends at the end of 27, I guess. I'm trying to keep the dates right. But that could be extended, maybe 28, 29. Because keep in mind, these contracts start to drop off. It doesn't stay at a constant 25% or whatever, 22%, and then stop. They were never designed that way. So could we see that? The Russian suspension of the export license. I understand there's been 3 potential deliveries, 2 of which didn't happen, and 1 of them did. And I'm hearing going forward, there may be deliveries that don't take place by the middle of the year. I think it depends on who the customer is and what's the volume. I'm continuing to hear the Russians have problems with uranium feed. They don't have enough to put through those. Well, they've got all this enrichment capacity. Well, to do that, you got to have the feed, and they don't have it. And it has to do with the mechanism of they deliver the SWU to the U.S. and then the feed gets shipped back, was the way, at least for some of the contracts. They can't do that anymore. I'm hearing that the feed that was held up in Western Europe, Urenco's buying it and overfeeding some of their enrichment plants because they're using that to deliver into the U.S. So, I mean, there's kind of weird stuff going on, but the whole Putin-Trump situation, everybody thinks they're the greatest buddies forever. Trump has said if the ceasefire, which apparently doesn't work now as of this morning, he's going to squeeze Russia with more sanctions. Well, at what point does nuclear fuel finally hit the wall? I think it's coming. So then if you're a utility, you go, ooh, looks like I'm not going to get those pounds or that EUP. The Chinese, my Chinese laundry, where they're buying Russian and delivering Chinese SWU, which, is being utilized by one big U.S. utility, Constellation. They're very upfront about it. Well, they're starting to tariff that to death. So when does that fall apart? Could happen soon. Again, as you get back to the starting off, there's so many moving parts that are not quantitative. If you're the engineer or the accountant, it doesn't work on the spreadsheet. No. It's all this other stuff that overwhelms the geopolitical issues we're now faced. And we haven't talked about Niger. And I mean, it's not just.
We will. Yeah. I promise we're gonna get this thing. We're gonna do this thing. Right. Right. I agree with you. It's very confusing when you're trying to, with an accountancy or a spreadsheet of investor, you're saying, right, okay, it's all this sort of down blending agreements, enrichment agreements, so Russia, maybe US, China, etc. It's very, very confusing. And one of the things I wanted to ask about was,
well, let me finish off. You did ask about the down blending of HEU.
Exactly.
The original megatons to megawatts program was highly controversial in Russia. The Duma was clearly wanting to either reduce the volumes or do away with it. So then when they talked about an HEU2, it was no way was it ever going to happen because you have a finite amount of HEU. And so the Russians cut theirs down to like 60%, and that's now gone. So I think that the general sense is the people that followed the old program, remember that took 20 years to implement because you have to have feedstock. You have to downblend the 90% weight percent weapons material with a whole lot of, they used actually 1.5% low enriched, but you've got to have tens of millions of pounds to downblend that HEU. So it doesn't work. The U.S. doesn't have the capacity to downblend a little bit, but not much. So anyway, long story short, that just isn't. Maybe in 2050, when we all like each other and want to de-weaponize, fine. Not going to happen for decades. So,
right, China. Obviously, China have been very strategic. They've kind of gone and done deals with Russia, done deals with Kazatomprom and Kazakhstan. They've gone big. We are talking about some utilities. Perhaps as their approach to de-risking is by I think you mentioned Encore and Paladin there. 12 contracts, 11 contracts, all small contracts. Sounds like utilities are basically saying, we gotta hedge our bets, we gotta spread our risk. I'm not sure which one of these guys is actually gonna deliver to us, but if we have multiple suppliers, we may be able to at least get by. That's defense strategy from the utilities again, right?
Now, the problem with that strategy is it's starting to reach a point where it doesn't work very well. Because if you for the utility, because they used to get plus or minus 20% under their old term contracts. So, okay, I'll take the risk with Mr. Little ISR guy. And if he doesn't deliver my 150,000 pounds, I can always go back to Cameco and Orano and the Kazakhs and load up my deliveries under existing deals. So, but now if you don't get those flexibilities, which are that's one of the new commercial terms and conditions, you can't implement that strategy very well. So you've got to then sign up for more firm deliveries from the guys you think are going to deliver. And it doesn't leave a lot for the guys that, well, I'd like to encourage them, but I got to run that $1 billion plant out there. And if they don't deliver, I got to have the fuel. So that's changing. Again, it's another factor on the whiteboard that you go, well, now what does that mean? So,
well, that's utilities. And then if you look at the companies, going back to the financing question or solution that we're trying to solve for, is they need long-term contracts. That's all I've heard from CEOs for the last 5 years.
Oh, sure.
Long-term contracts to make the banks feel comfortable so that I can get the capex I need to build this thing and eventually get into revenue. That's the name of the game for all businesses, right? The Chinese don't have that problem. They got all the money they need. It's because most companies are government owned. They're sovereign owned, so they don't have to worry about competing. They just get on with the doing, and long-term contracting isn't even in the conversation, is it?
No. So at the end of the day, as a utility, you have to be careful. How much do you sign up for? from the state-owned producers, because when they're, be it China, be it the Kazakhs, when they get called on from the Russians and the Chinese, who are they going to deliver to?
Yeah.
I mean, so.
And plus, I think the uranium companies going, oh, we're going to contract with the Chinese. No, you're not. They're either going to buy you or not buy you. Those are the two binary options that the Chinese are going to go
to
for.
Some degree, they
right?
do long-term contracts, but it's like with the Camicos and it's like with the Emirates. They've got a big contract with the Russians. They now have a big contract with the Kazakhs. They like dealing with the big guys. And what are you going to do? Again, if you're the small uranium guy, then I think you face a different world than if you're one of the either state-owned guys or a Cameco, where you're going to produce, 25, 30 million pounds a year, whatever, deliver 35 million. That's a different business model. So the old days of the little ISR guys in Texas, I mean, I worked at Everest. We produced I looked it up once, 600,000 pounds was the biggest year we ever had. So how do come on, how do you stay, you're not in the industry really, you're just kind of a little guy, putting out a few pounds. So it's not, you go do oil and gas, you go do something else.
Yeah, and I think oil and gas reminds me. So if I look at Bill Sheriff, he's I think put out a statement recently. Well, there's a few things he put a statement out about recently, but one of them was around the M&A side of things, where they said they will continue to look at M&A, but they're not going to consider a lot of the small US producers because it doesn't amount to a whole hill of beans. And Boss Energy, Duncan Crave, who I spoke with this morning and interviewing next week, he said, we've looked at a lot of the stuff in North America, and quite frankly, it's hard to find things which going to meet our criteria, and by that he means big or potentially big. So it's for sure really, really, really tough out there at the moment. Just on I guess we did say we talk about M&A and roll-ups and so forth. We've seen a few companies do it. Obviously, UEC has been quite successful at the M&A game, and they produced one barrel of U3O8 now.
U3O8. Well, that project works. It's just you got to put the well fields in. You got to get it going again, and
Yeah.
So,
but it's not bad. Whatever, $4 billion company, 1 barrel of U3O8, good. And it's you got Dennison talking about the ability. Hopefully, if they get through the session coming up, I think in April, they might be able to start a process of looking at how they go about funding and building their project. Next Gen, obviously, they've got a financing issue that they need to solve. And Cameco, let's see when they bring things back online and the speed at which they move. So it's a very, like I said, it keeps coming back to the supply thing for me. This whole conversation is supply, and I'm excited for those who can, but I'm not seeing a lot of people answering that question. Right. Thing I do want to talk about, Niger. You mentioned it earlier. I think GoVX look like they're going to talk to the government about a roadmap of how they solve what's going on there. What are your expectations there? Because I think I'm not sure GoVX necessarily want to be in country, and I'm not sure their investors want them to be in country. It's a bit of a mess. But if there could be some resolution where they could extract some value, and by value I mean money, by maybe a Chinese person coming out and saying, I will take this off of your hands. Do you think that's a kind of quite nice solution for what has been a very difficult run for them?
Yeah, I think that, unfortunately with the change in government, which was significant, let's put it that way, the current government certainly doesn't want the West in there, be it the US or France or whatever. And, the French are going to pursue every legal avenue. I draw your attention to the Worldwide Minerals Kazatomprom lawsuit that just the settlement got revoked. I was involved on the Worldwide Minerals side. And the point being is, even some of the producing countries you feel comfortable with can create difficulties. So why would you do it? Unless you're going to get a significant benefit from the product. In other words, it's such low cost or whatever. I don't see that in Niger. And I think the Russians, needing uranium, they do, have moved in, and they're going to run the show. Global Atomic, I think Steve Roman and the group are doing the best they can. They're meeting with the government. The government's giving them all the right signals. But would I trust the government? No. They're talking to the Minister of Mines. The president calls up and says, hey, guess what? It's, I wouldn't go in there with a new project. There's no way. Why would you? So that's off the screen.
With Global Atomic, that's a case of show me the money, and I think there's some rumors circulating that perhaps it's certainly not going to come from the DFC, but perhaps there is another party there. I suspect, well, Chinese, Turkish.
Yeah. So then again, you look at the risk profiles of a lot of this stuff, and you go, boy, at a low price, it doesn't make sense. It does not make sense, so I'm not doing it. Which
but wait, come back to our earlier point about the Chinese don't care, right? Doesn't matter. Yeah, I need the product. I need the product is what I need. We can, and quite frankly, if no one else is going to fund it, that's, you're going to pick it up cheap, right? And you look at the public, market cap profile at the moment, it's down there at bargain basement level. If they can get a Western financing solution, I think it's great. And I'm not sure whether I put Turkish government or Turkish money in that category yet. It could be. It kind of sits in that hinterland, doesn't it? Somewhat.
Could be. The Chinese have become kind of not untouchables, but in the industry, that's not the enthusiasm for, getting involved with them. So I've had people say, well, should I bring them in? And I say, no, sell off the company. Let them buy everything, because you don't want to try to deal with them because they have a different business model. I'm not saying it's bad. It's just they don't. It's oil and water. It does not mix. And look at Kazakhstan. I've been told repeatedly, future production is going to Russia and China. So they're like this in Kazakhstan. Do they do the same thing in Niger, where the Chinese and the Russians kind of somehow get along on the uranium front? Yeah, but it's small potatoes. It's not very big. So you go, well, yeah, could. So, but the Chinese are out shaking the bushes, I can tell you. So don't be surprised if they show up, who knows where. It won't be in the U.S. It won't be in Canada. Won't be in Australia. So they're going to be, they're around. So
they're in the breadbasket of Africa.
They are.
We know that.
And what about South America? When do they show up in Argentina, Peru, whatever, and say, we'll go out and do the exploration.
Yeah.
So
I think they're already there. I certainly see oil and gas game, iron ore. For sure, lithium definitely. I think South America is open for business as far as the Chinese concerned. They don't have any restrictions there. Okay. So just these are the big questions. I think again, sticking with kind of supply thing is junior miners are struggling to fund exploration just across the board. Uranium's no exception to that. The sheen has come off somewhat in terms of money being thrown. You've got some development stories which are kind of moving through the phases, and you've got a less than a handful of people talking about whether it be mine restarts or new mine builds. Do you think consolidation is going to be necessary to kind of, or required to create a more robust supply chain? So consolidation of uranium companies, and possibly even with on the processing side, upstream, or so downstream, I should say, is that going to need to be more integrated And if so, do you see it happening anytime between now and 2030?
You mean like tomorrow?
Yeah.
Yeah, I think the consolidation up to a point. There'll be companies that are trying to be built to produce that. Pick a number, 5 million pounds or whatever. So they're a larger player. On the conversion side, Cameco, Orano already are integrated, as we know. The only one who isn't is Metropolis with Honeywell, and that's up in the air. The fact that they are spinning off advanced materials puts that facility kind of not in question, but unlike to expand, I think, in the near term. If you're the new management of the Advanced Materials Inc., whatever, you're going to have to look long and hard at expanding Metropolis on the UF6 side. Remember, they produce other fluorine products. So the plant isn't a single use. Should somebody, it was looked at when I was at Converdyne. Should we get involved with General Atomics, with the uranium, and make it a more integrated? Never worked. So, we used to try to put together natural UF6 contracts with Nufcor, the South African producer, and ERA in Australia, and we could never get the thing to work. Everybody wanted a premium on either the service or the product. So it's been looked at. I think Springfields in the UK will come on, and I think it'll be obviously dominated by Cameco Westinghouse. And I don't think there'll be a lot of conversion made available outside of that. Just my guess. If I'm Cameco, I wouldn't let it go. So, we'll see if there's, and then enrichment, it's hard. Certainly, Urenco, should somebody be working with them on the deals that Cameco's done in Ukraine? They did uranium conversion. Urenco did the enrichment. Westinghouse did the fabrication. Well, the only thing Westinghouse Cameco is missing is enrichment. And they're looking at GLE being built in the U.S. So maybe that changes where they're fully integrated on fabricated fuel. Could be the direction they're going. That's what the French did. So again, we started out seemingly a while ago, everything's in flux.
Yeah.
And so then if you're a utility conservative, you're going, boy, I had a fuel manager tell me not too long ago that with the change in procurement, kind of a constant presence in the market, he said most utilities don't have the decision-making structure in order to do that. I need 30 days, I need 60 days to make a decision. I got to have every, risk management, treasury, finance, generate everybody involved. They're almost Japanese in that sense. So he said there's going to be a painful transition to a more sophisticated procurement environment. And I don't disagree with that. It almost is non-nuclear engineers. It's trader commercial guys that understand the fuel cycle. Well, where do you get them? So anyway, we'll see.
I think we will see, and I'm probably going to have to wrap it up here today. And there's so much we haven't discussed.
Yes.
Around the kind of M&A, whether it be in US, Athabasca, or Australia, or whether the Camecos and Kazals and Proms or others are going to step in. And I think in terms of all those kind of long-term driver components. So I think for investors listening to this, apart from the financing, discovery, supply, processing, procurement, everything's good, right?
Well, yeah, but to me, it all means higher prices. Prices have to go up, either from a lack of supply, or to build the new supply. It's got to go. And if it doesn't, then you won't see the necessary supply. The suppliers have made that crystal clear. So it's not debate.
It's got to react.
Yes.
Basic economics. Says it should react. If it doesn't, it's just strangle. It's we see those snakes who just strangle themselves to death and
Exactly.
die
That's
quietly
right.
in the corner of the desert. That's kind of where we're at, folks. Well, look, Justin, we must have you on again soon. Maybe finish that conversation, and there'll probably be some other
Absolutely. We got
news.
a couple of conferences coming up, Montreal
Yeah,
and Sydney, and so there'll
brilliant,
be things are going to change. So, all right.
brilliant. Okay, so thank you very much.
Good to see you.